Hey guys, welcome to the Bitcoin Fortress podcast, helping you increase your financial freedom. This is episode 110, recorded on April 7th, 2024. This podcast is for entertainment only, not investing advice. As always, do your own homework. Well, we got a lot to go over this week, starting with the market update outlook, get into the top Bitcoin news and commentary, and we'll finish with the week's featured post on the Bitcoin Fortress Substack. And let's jump right in. The benchmark S&P 500 posted its worst weekly performance of the year on Friday, and only its fourth overall negative week of 2024. The decline was primarily driven by strong economic data on the labor market, which increased bets that the Federal Reserve would be in no hurry to cut interest rates. Additionally, a rally in commodities led to a resurgence in inflation fears, while a jump in Treasury yields also put pressure on equities. Friday's non-farm payrolls report blew past expectations, with the economy adding 303,000 jobs, the unemployment rate ticking down, and the labor force participation rate inching up. The data underscored bets that the Fed will be in no rush to cut interest rates, and markets have dialed back their odds of a 25 basis point rate cut at the central bank's June policy meeting. For the week, the S&P 500 retreated 1%. The tech-heavy Nasdaq lost ground by 0.8%, and the blue chip Dow slipped 2.3%. So bad week for stonks and bonds too, actually. Looking ahead, all eyes this week will be on Wednesday's Consumer Price Index report for March. Headline CPI is expected to rise 0.4% on a month-over-month basis, flat from February, and an increase of 3.1% on a year-over-year basis, slightly lower from 3.2% prior. Core CPIs seem to be decelerating on both a month-over-month and year-over-year basis to plus 0.3% and plus 3.7%, respectively. I don't know about you, but that's not what I'm seeing when I go to the grocery store. So anyway, numbers probably are not reliable, but at least they're maybe directionally accurate. I don't know, but I think it's all garbage. Additionally, investors will be looking out for the minutes of the Federal Reserve's March minutes, also scheduled for Wednesday, following last week's hot labor market data that dented interest rate cut odds. Market participants will be closely watching the minutes and the consumer inflation report for further clues about the future of monetary policy. Next week will mark the start of the first quarter earnings season as well. Delta Airlines and Corona beer giant Constellation Brands will report on Wednesday and Thursday. Friday, we'll see quarterly numbers from major banks, JP Morgan, Wells Fargo, and Citigroup, along with the world's largest asset manager, BlackRock. Okay, jumping into the top Bitcoin news. This first one here is from bitcoinnews.com, was posted today. Article's entitled Another Whale Awakens Amid Bitcoin's ETF Boom. Recent developments in the Bitcoin market have brought both excitement and intrigue to the forefront. On one hand, the spot Bitcoin exchange-traded fund market has witnessed a staggering influx of capital, while on the other, a long-dormant Bitcoin whale has resurfaced. As per the latest data, the spot Bitcoin ETF market has experienced an unprecedented surge in inflows, with total net inflows surpassing $12.6 billion, with an average daily inflow of $213.8 million. The market has seen a remarkable streak of 4 consecutive days of net positive flows. Leading this charge is BlackRock's IBIT, which recorded a net inflow of nearly $308 million on April 5th alone. This significant addition brings BlackRock's total net inflows to an impressive $14.77 billion. Following closely behind is Fidelity's FBTC, which registered a net inflow of $83.02 million on the same day. Notably, FBTC has accumulated a cumulative net inflow of $7.96 billion, solidifying its position as a key player in the ETF market. Bitwise's BITB also made its mark with a net inflow of 7.39 million, bringing its total net inflows since launch to 1.66 billion. However, amid this surge in positive activity, Grayscale's GBTC keeps bleeding funds, recording a net outflow of 199 million on Friday, with total net outflows amounting to 15.5 billion. Grayscale continues to experience negative inflows, signaling a divergence from the bullish trend seen in the other ETFs. And that's probably because they're charging 1.5%, and nobody wants to pay that much. Meanwhile, a Bitcoin address that lay dormant for a decade sprung to life on April 6th, holding 1,701 Bitcoin, equivalent to a staggering $115.41 million. This sleeping giant reawakened with a significant transaction on April 6th. The resurgence of this dormant Bitcoin whale caught the attention of Whale Alert, a prominent tracker of large transactions, which promptly alerted the community on social media platform X. The address, characterized by its one prefix, a hallmark of legacy Bitcoin wallet addresses, had previously made headlines in 2014 when it spent 2,570 Bitcoin, valued at $1.6 million at the time, when Bitcoin was priced at $625. Following this transaction, the address remained inactive for the ensuing 10 years. Notably, the wallet has accumulated a total of 4,272.29 Bitcoin over its history. As per the current market price, this sum, if held, would command a jaw-dropping valuation of around $300 million. This sudden activity from a long-dormant whale serves as a stark reminder of the influence large holders can wield over the market. While it's unclear whether this transaction signifies a strategic move or merely routine balance management, investors must remain vigilant about potential sell-offs that could impact prices. As Bitcoin continues to navigate fluctuations in price, currently trading at around $69,000, investors find themselves at a crossroads, grappling with the contrasting forces at play. With a market cap of 1.3 trillion, Bitcoin maintains its position as the undisputed leader in the digital asset market. Just keep stacking. Don't worry about the whales. Don't feed the whales, certainly. That means don't sell your Bitcoin to the whales or to the ETFs, because it's better in your hands. Next up is from Crypto Potato. This article was posted on April 5th. A little bit more commentary on price. I don't normally like to go into this, but it's probably good, especially for newer people in Bitcoin that are probably freaking out about drawdowns and stuff like that. This article is entitled Bitcoin Current 18% Retrace is right on schedule and is actually good news. Here's why. Bitcoin is in the first phase of its halving and is on track with analyst predictions, crypto trader and analyst Rect Capital has revealed. According to a tweet, Bitcoin's 18% retrace in the past weeks was expected, as similar slumps occurred before the second and third halvings. This indicates that Bitcoin would repeat many of the incidents witnessed in previous events, including the post-halving surge that would propel the asset to new highs. The three phases of the Bitcoin halving are the final pre-halving retrace, the reaccumulation, and the parabolic uptrend. The first stage usually occurs 28 to 14 days before the event and can last for weeks. The second phase comes after the retrace has bottomed and can last up to 5 months, while the third can last for more than a year. During the halving in 2016, the retrace was 38% and spanned over 4 days. In 2020, it was 20% deep and lasted 8 weeks. With Bitcoin roughly 13 days from the halving, the asset has declined approximately 18% over the past 3 weeks. Rect Capital noted that this cycle has exhibited some qualities from both the 2016 and 2020 halvings, and as a result, may repeat pieces of their pre-halving price tendencies. Nevertheless, Rect Capital said the goals of the pre-halving retrace period include offering one final bargain buying opportunity, setting up the next phase in this particular cycle, and forming the range low of the future reaccumulation range. On-chain metrics suggest that Bitcoin may be at the onset of the reaccumulation phase, with the asset's resistance level at 70,000. Rect Capital said Says the market may have established the high reaccumulation range. Since reaccumulation comes after the retrace has bottomed, it is also possible that the pre-halving bottom is in. The goal now, according to Rect Capital, is for Bitcoin to move sideways up until the halving and beyond. Notably, this is the first time the reaccumulation range is developing around the new all-time high area. This may shorten the duration of the phase and cause the range to take the shape of the regular sideways movement the market has seen so far. So yeah, just keep stacking and be patient and wait, and we'll see where Bitcoin chooses to go. Um, maybe up, maybe down, but certainly if your time horizon is long enough, which it should be 5 to 10 years, you're going to be just fine. Next up is from Cointelegraph. This article is entitled "Bitcoin Pretty Unlikely to Revisit 50K Price Level," says analyst. This one was posted, let's see, yesterday. The frequency of Bitcoin reaching higher support price levels, as well as lack of immediate froth in the derivatives market, suggests that the price is unlikely to retrace down to 50,000 anytime soon, according to a crypto analyst. Senior analyst at digital asset fund UTXO Management, Dylan LeClaire, explained in an analyst note on April 7th that if Bitcoin rises back into the $70,000 to $75,000 price range, it will put significant pressure on short positions. As we've consolidated, an increasing amount of short liquidations are building from 70 to 75,000, he stated. If Bitcoin's price rises to 70,000, approximately 174.17 million will be liquidated, according to CoinGlass data. Should it reach the upper boundary of Leclerc's range, 75,000, around $830 million worth of short positions would face liquidation. This translates to roughly a 7.8% increase from Bitcoin's current price of 69,344. Likewise, a similar percentage change of 7.5%, but in a downward movement, occurred on March 15th, resulting in 525.2 million in liquidations. And these are all people that are basically buying options, either puts or calls. And so, they'll just get wrecked in both directions. That's why the best thing you can do is just buy the Bitcoin and hold it in cold storage and just sit back and watch, have some popcorn. Leclerc explained, although a decline in Bitcoin's price to 50,000, a 27% decrease from its current price at the time of writing, could trigger substantial liquidation of long positions, he doesn't foresee it considering the recent price shifts and the increasing support levels. While there is a large cluster of longs that could be taken out at 50K given the structure of higher lows and the lack of immediate froth in the derivatives landscape currently, I find it pretty unlikely we revisit that level, he stated. Not impossible, of course, he warned. Bitcoin's price last dipped below 50,000 on February 13th, hitting 49,725. Just the day before, on February 12th, it reached 50,000, a level not reached since December 2021. He backed up his claims by citing the recent action by global asset manager BlackRock, which updated its Bitcoin exchange-traded fund prospectus on April 5th, adding 5 big Wall Street firms as new authorized participants. New members include ABN AMRO Clearing, Citadel Securities, Citigroup Global Markets, Goldman Sachs, and UBS Securities. Prominent crypto traders are speculating over Bitcoin's price ahead of the halving event, which is set for April 20th. This event occurs every 4 years and will cut miner block rewards by 50%. From 6.25 Bitcoin to 3.125 Bitcoin. Cointelegraph recently reported that Bitcoin's price has risen around 658% since the last Bitcoin halving in 2020. If historical chart patterns were to repeat, Bitcoin's price would reach $434,280 per coin by the 2028 halving if it performs similar to the current cycle. And then here they also mention the article we just went over. Crypto trader Rect Capital believes there's considerable potential for further upward movement in the short term. He told his 443 followers in an April 7th post that the market is approximately 1/3 through the bull market phase. Okay, so a little bit more bullish news there. And of course, we don't really care too much about the market price. If it dips, it's a good opportunity to buy. If it goes up, you should just be happy. And if you're dollar cost averaging, you should be building a good position over time with all the ups and downs. Next up, this is from bitcoinnews.com, one of my favorite sources. They've got some really, really good news here. This one was posted on April 5th. Morgan Stanley and UBS reportedly competing to launch first Bitcoin ETF. So this is a little bit of adoption news. Investment banking giants Morgan Stanley and UBS are locked in a tight race to introduce the first spot Bitcoin exchange traded funds in the United States. That's interesting. This This competition underscores the increasing acceptance of Bitcoin within traditional banking sectors and could have far-reaching implications for investors. Huh. Well, we already have Bitcoin ETFs in the United States. I guess these are the first for them. Both Morgan Stanley and UBS are eagerly vying to secure the title of being the first, major bank to offer Bitcoin ETFs. Got it. Reports suggest that Morgan Stanley appears poised to edge out UBS in this race, with insider sources indicating that an announcement could be imminent. Again, they're probably missing out on making a lot of money, like BlackRock and all of these others, Fidelity, etc. So that's why they want to jump in, so they can sell this as a proprietary fund to their customers and make money. Not that they like Bitcoin, they just are missing out on an opportunity to make some money. The strategic move by Morgan Stanley highlights a broader shift towards embracing digital assets within the conventional financial ecosystem. This news was announced by Andrew Parrish, co-founder of Arch Public on X. Before publishing the latest update, Andrew stated that UBS intends to introduce Bitcoin ETFs on its platform from April 8th to April 12th. Recent speculation suggests Morgan Stanley may counter UBS after Andrew's report of the bank's forthcoming approval of Bitcoin ETFs. Despite the excitement surrounding the potential launch of Bitcoin ETFs, major banks like Morgan Stanley and UBS are navigating a complex compliance landscape. Eric Balchunas, a Bloomberg ETF expert, describes the situation as a compliance game of chicken, with each bank waiting for the other to make the first move. This cautious approach underscores the regulatory uncertainties that still linger in the digital asset space. Eric Balchunas states, FWIW, I heard from solid source, none of them have added the Bitcoin ETFs, still in holding pattern in a compliance game of chicken, waiting for one of them to go first and then give the rest cover. So probably will be an all at once type of moment when that is, though, is questions emphasizing the strategic waiting game being played by banks. So I guess what this is saying is that they currently don't offer Bitcoin ETFs on their platform to their investors, whether they're accredited or not accredited or whatever. And so not that they're going to launch Bitcoin ETFs, but they're actually going to bring the existing ones that are being traded onto their platform and make it available to their customers. That's what I think this is trying to say here. He predicts that once one bank receives approval, others are likely to follow swiftly. He emphasizes the potential impact of ETFs on increasing accessibility and demand for Bitcoin among traditional investors. And I'm sure there's some kind of compensation that goes back and forth between the ETF issuer and the platform that's selling the ETFs, they'll probably peel off part of the fees that they're collecting from the investors in the ETFs to incentivize this retail distribution by the banks. So there is money in it for the banks. On the other hand, despite ETF approval, certain prominent U.S. banks remain doubtful about Bitcoin's legitimacy. Goldman Sachs top investment officer Sharman Mosavar Rahmani, a Bitcoin skeptic, spoke to the Wall Street Journal on April 2nd. She stated, "We do not think it is an investment asset class. We're not believers in crypto." Okay, then. The introduction of spot Bitcoin ETFs would mark a significant milestone in mainstream Bitcoin adoption. These ETFs, which would The spokesperson for UBS previously mentioned that spot Bitcoin ETFs are only suitable for aggressive investors. It remains to be seen if the issuers will be able to distinguish themselves in terms of ability to manage the product during turbulent markets. Well, I guess we'll see what happens. I mean, this is just more retail distribution, it sounds like, for the existing ETFs. And Morgan Stanley and UBS are both in a hurry to offer this to their customers, but I wouldn't be surprised if they limit it to, accredited or institutional only, and the retail could just not, it's too risky for them. So again, that being the case, you can just buy Bitcoin yourself and self-custody it, and you don't have to have them siphon off 0.25% or 0.4% or 0.5% or whatever fees are being taken out of the ETFs forever, and they'll probably go up. The next article is from BitcoinNews.com. This is entitled "Genesis Buys 2.1 billion worth of Bitcoin amid bankruptcy proceedings." In light of its bankruptcy situation, Genesis opted to sell off 36 million shares of the Grayscale Bitcoin Trust shares. This move was aimed at settling debts with creditors and navigating through the challenging financial landscape. According to reports, Genesis liquidated the GBTC shares, yielding $2.1 billion, which was promptly used to purchase 32,041 Bitcoin. This strategic allocation of funds underscores Genesis' commitment to repaying its obligations while reinforcing its position in the Bitcoin space. Coinbase, a leading exchange, weighed in on the matter, assuring the community that the sell-off and subsequent Bitcoin acquisition by Genesis were unlikely to have a significant impact on the market. Coinbase stated, "Our view is that much of these funds will likely remain within the crypto ecosystem, contributing to a neutral overall effect on the market." Industry analysts have been closely monitoring Genesis's actions, particularly in relation to the broader market dynamics. Arkham Intelligence highlighted the connection between Grayscale GBTC's outflows and Genesis bankruptcy proceedings. The liquidation of GBTC shares, coupled with Genesis Bitcoin purchases, has led to significant market movements impacting both Bitcoin's price and the broader altcoin market. So yes, when we talked about earlier, the GBTC outflows, probably a lot of that has to do with the bankruptcy, it sounds like. And I'm sure plenty of it has to do with people that were stuck in there that wanted to get out. And then also the fact that their fees are much higher than, all the competitors. So if you're in GBTC, why wouldn't you sell it and buy a different fund that has a lower fee? GBTC saw significant outflows, hitting a peak of 642 million on March 18th. Per BitMEX research, the trend persisted until April 3rd, with outflows around 75 million. Genesis' decision to reinvest in Bitcoin amidst bankruptcy proceedings raises questions about its repayment strategies. The company's move to convert GBTC shares into Bitcoin aligns with its efforts to address financial obligations. However, the effectiveness of the strategy in meeting creditors' demands remains to be seen. The Genesis saga underscores the complexities and volatility inherent in the landscape. While Genesis Bitcoin investment signals confidence in the asset's long-term prospects, its impact on market dynamics warrants close observation. And the correlation between GBTC outflows and Bitcoin's price fluctuations highlights the interconnected nature of the market. So it is kind of interesting because, I mean, if it's a bankruptcy estate, you would think that they would just be going to cash, so they could distribute cash to to the affected folks. But maybe they're thinking, well, they're going to want Bitcoin, and Bitcoin's probably going to keep going up because it's in the bull market. So why not? And then maybe they could potentially distribute more value to the creditors in the bankruptcy estate as a result. Who knows? But interesting nonetheless. Next article is from BitcoinNews.com. Again, this was updated today. Articles entitled "Miners Rush to Grab Remaining 6.25 Bitcoin Block Rewards Pre-Halving." As the Bitcoin community eagerly awaits the upcoming halving event in April 2024, which I think the current projection is something like April 20th, miners are ramping up their efforts to maximize profitability amidst increasing competition and declining transaction fees. Miners are actively exploring strategies to increase their earnings prior to the halving scheduled for April 2024. And just so those of you, everybody probably knows this already, but the halving event means that the number of coins that are issued to the miners when they solve a block will be cut in half. So it's going to go from 6.25 to 3.125, which means obviously the new supply of coins that comes out every day will be cut in half. And so all things being equal, if demand stays the same, that typically drives the price up. But that also reduces the amount of money that miners can make. So in past cycles, that's caused miners to go out of business or shut down or whatever and consolidate. There's a lot of speculation about if that's going to happen again, or if miners are prepared for this better this time around and are running more efficiently. So I guess time will tell. Anyway, back to the article. According to a report from leading analytics platform CryptoQuant, Bitcoin miners have significantly increased their selling activity in the lead up to the halving. Daily sales to over-the-counter desks peaked at 1,600 Bitcoin in late March, marking the highest level since August 2023. This surge in sales, and by the way, miners are the natural sellers in the Bitcoin ecosystem, and the natural buyers being folks like us, ETFs, investors, Michael Saylor. This surge in sales reflects miners' strategic efforts to boost their rewards before the anticipated reduction in block rewards from 6.25 to 3.125 BTC per block. Despite the surge in sales, miners are facing numerous challenges that threaten their profitability. Lower transaction fees, increasing competition are among the key concerns. The reduction in Bitcoin block rewards will slash miner revenues by 50%, necessitating higher Bitcoin prices to sustain profitability. Continual obstacles such as reduced transaction costs, heightened competition in mining, and the demand for greater computational capacity are exerting strain on individuals engaged in Bitcoin mining. CryptoQuant analyst explained, and this is a quote, "Indeed, transaction fees as a percentage of the total block reward, new Bitcoin issuance plus transaction fees are at low levels. Transaction fees represent 3% of the total block reward, down from 37% in mid-December 2023. Fees were also around 3% prior to the previous halving in May 2020. Higher fees or Bitcoin prices are needed to compensate for the loss of block reward." The recent surge in the Bitcoin network's hash rate, specifically its 9.96% rise in the past 24 hours to over 630 exahash per second, indicates intensified competition among miners vying for the same rewards. The hash rate, measured in hashes per second, reflects the total computational power dedicated to mining and securing the network. As the hash rate increases, it signifies a higher level of security and resilience against potential attacks. The rising hash rate signals more competition among miners for the same rewards, which in turn increases network security. The upcoming halving event is poised to be the most significant in Bitcoin's history in terms of the US dollar denominated reduction of miner rewards, with rewards set to drop from 6.25 to 3.125 Bitcoin per block. Miners are expected to face a 3 to 7% reduction in active participation, while some reports even expect 20% of network hash rate to go offline post-halving. The halving event will have a significant impact on miner rewards and profitability. Amidst the challenges posed by the halving event, the continued adoption of Bitcoin exchange-traded funds offers a glimmer of hope for miners. ETFs provide institutional and retail investors with exposure to Bitcoin's price movements without directly holding the underlying asset. This could help absorb selling pressure and contribute to a more stable demand for Bitcoin. Bitcoin ETFs could play a crucial role in mitigating the negative impact of the halving event on miners' profits. Certainly could be the case. I guess time will tell. All right, next up is another article from BitcoinNews.com. This is this was posted today. Blockchain analyst harassed by the IRS to help them solve a crime. Zach XBT, known for his expertise in tracking down fraudsters within the digital asset space, has raised concerns about what he describes as harassment by IRS CI agents. In multiple instances detailed by Zach XBT, IRS agents have allegedly gone to great lengths, including tracking old addresses and contacting personal emails using private data to solicit his help in ongoing blockchain investigations. He expressed his discomfort, stating, "I've been borderline harassed by IRS CI agents on 4 to 5 occasions now in the past few months with a blatant disregard for any professionalism, so I've decided to now share this publicly." The alleged harassment came in the form of persistent requests for Zach XBT's assistance in solving blockchain crimes. Emails shared by the analyst depict an IRS special agent praising his work and seeking guidance in navigating the complex world of blockchain investigations. The agent admits their limited knowledge of the digital assets cyber arena and expresses a desire to make a significant impact with Zach XBT's assistance. In one instance, an agent wrote to him, "I ran across your profile on social media and I've seen some really impressive work, especially your use of blockchain tracing tools. I've been an IRS CI special agent for a while, but I'm pretty new to the crypto cyber arena. Was hoping you could give me a sense of what I should be looking at if I wanted to make the biggest impact." Zach XBT perceives the IRS CI's actions as a violation of his privacy. By reaching out through personal channels and old addresses, he feels his boundaries have been crossed. This sentiment is echoed in Zach XBT's statement. They've shown up in real life to old addresses, contacted personal emails using private data, have sent mail when I have public contact methods readily available, highlighting the invasive nature of the IRS CI's approach. Zach XBT's decision to publicly disclose the alleged harassment coincides with his refusal to assist holders of the complex, simple meme coin, which faces threats of shutdown. While expressing a willingness to aid victims of real investing, Zach XBT expressed reluctance to dedicate time to those involved in speculative meme coins. This stance underscores his commitment to prioritizing legitimate cases over volatile investments. He noted that he doesn't like spending long periods of time helping people who willingly choose to gamble on vaporware meme coins versus actual victims. Despite Zach XBT's allegations, the IRSCI has been actively seeking collaborations to enhance its capabilities in investigating digital asset-related crimes. Partnerships with blockchain analytics firms like Chainalysis have provided invaluable tools and infrastructure. IRSCI Chief Jim Lee noted a significant impact of these collaborations, citing the seizure of approximately $10 billion worth of digital assets since the unit's focus shifted to the field. Zach XBT's experience sheds light on the evolving dynamics between independent investigators and government agencies in the digital asset sphere. While collaboration can enhance law enforcement efforts, concerns about privacy invasion and professionalism remain pertinent. The incident sparks a broader conversation within the community about the balance between cooperation with law enforcement and the protection of individual rights. So I thought that was kind of an interesting piece, and I don't really know what to think. I guess it seems like the IRS ought to hire some people and train their folks instead of bugging private citizens. Maybe he'd be willing to do it for $200 or $300 an hour. You never know. Next up, this is an opinion piece from Bitcoin Magazine. This was posted on April 5th. I thought it was kind of interesting. National Emergency, Executive Order 6102, and the Heist of the Century. 91 years ago today, President Franklin D. Roosevelt pulled off the greatest heist in American history. Unlike most robberies, this one was entirely legal. No safe cracking was required, no ski masks, guns, or getaway cars, just a pen and some White House letterhead. On April 5th, 1933, FDR issued Executive Order 6102, making it illegal for anyone in the United States to own gold by a penalty of up to $10,000 fine or 10 years in prison. Everyone in the country was ordered to turn in their gold to the government by the end of the month. Executive Order 6102 is one of the most important milestones in the history of money, bookended by the creation of the Federal Reserve in 1913 and the end of the Bretton Woods system in 1971. It was a pivotal part of the process by which the USA abandoned gold for a fiat standard. As such, it's a milestone in Bitcoin history too, though Bitcoiners' interest in EO 6102 extends beyond the merely historical, because it's the quintessential cautionary tale of arbitrary government seizure of personal property. It's also one of the best real case studies to illustrate the value of Bitcoin self-custody. Realizing that the government is not your friend is like learning that Santa Claus isn't real, a necessary part of growing up, but a potentially traumatic fact that needs to be introduced to children carefully. Nonetheless, adulthood requires coming to grips with the fact that there's no jolly fat man coming down the chimney with gifts in hand. In the real world, the strange fat man wears a frown and comes through your front door with an arrest warrant if you don't pay your taxes. For many people, the story of Executive Order 6102 brings them into collision with this reality. It teaches us that the United States government has not hesitated to brazenly confiscate its citizens' wealth at the barrel of a gun, and under the right circumstances would absolutely do it again. However, most discussion of 6102 focuses on why FDR did it and whether it was justified. This debate is framed around FDR's overall handling of the Great Depression. On one side, you have essentially FDR hagiography, which says that he was an unmitigated American hero, that without his New Deal, we would all have been lost. On the other side, you have the somewhat milquetoast Republican criticism, which says, well, maybe FDR went too far, or maybe he actually hurt the economy as much as he helped it. Sometimes a spicy libertarian will get hot under the collar and tell you FDR sent America down the path to welfare statism and accustomed Americans to the pernicious dole. All of this misses the most important lesson from EO 6102, which is how FDR pulled the whole thing off. I mean, technically, legally. This is because despite the fact that FDR's presidency could justifiably be characterized as a quasi-dictatorship, and in the words of America's foremost FDR disrespecter, Curtis Yarvin, aka Mencius Moldbug, rule by personal decree, there were specific legal precedents and tools of executive power that he relied on to make EO 6102 kosher. The legality, fig leaf for tyranny as it may have been, is crucially important to understand. It was one of the foundational steps in codifying what would go on to become a technique for abusing Americans' rights, favored by almost every president, and has been implemented literally dozens of times in the decades since. If we have any hope of putting a stop to it, we must first learn to see it from a distance and then stomp it out preemptively. And this is a direct quote from Machiavelli. Now, in a well-ordered republic, it should never be necessary to resort to extra-constitutional measures, for although they may for the time be beneficial, yet the precedent is pernicious, for if the practices once established of disregarding the laws for good objects, they will in a little while be disregarded under that pretext for evil purposes. I'm not sure anyone's ever said that the conduct of American presidents has on the whole not been Machiavellian enough, but in this case, the historical record is clear. Dating back at least to Abraham Lincoln's suspension of habeas corpus in 1862, so he could lock people up without trial during the Civil War, disregarding the laws for good objects has been practically a job requirement of the Oval Office. Carl Schmitt said that sovereign is he who decides on the exception. Every U.S. president since Lincoln has made absolutely sure, when necessary, to create and exploit extra-constitutional exceptions for their own ends. In Schmidt's case, well, you can Google him to see how he put principle into practice. In order to manufacture these exceptions in America, presidents have almost always resorted to the incantation of a particular phrase, which reliably summons the special powers they seek, much like coaxing a genie from a lamp. The phrase is national emergency. Likely, it is familiar to you. If you're an American adult, it's been invoked in your lifetime to help grease the skids for a colorful variety of constitutionally suspect legislation, from the anti-terrorism provisions of the Patriot Act to the public health emergency measures of COVID-19. In fact, it's such a mainstay of the government toolkit that the use of the national emergency has been officially sanctioned since the 1976 National Emergencies Act. Since that date, 82 such emergencies have been declared and 42 are still in effect today. Wow. To give you a sense of the temporal nature of these emergencies, there are still in effect 9 from the Obama administration, 10 from Bush 2, 5 from Clinton, and even 1 from Jimmy Carter in 1979. This is what Milton Friedman was talking about when he said, "Nothing is so permanent as a temporary government program." This is also the story of Executive Order 6102, for it too sprouted from an official and national emergency. You can read this order itself, where FDR states in the preamble, "I, Franklin D. Roosevelt, President of the United States, do declare that said national emergency still continues to exist." And there's an actual copy of the executive order here in the article. And again, I'll put links to all the articles that I'm going through here in the notes so you can read them for yourself. But still, the story goes deeper. It's not just enough to declare a national emergency and then do whatever you want. That certainly wasn't the case in 1933. So what was FDR's national emergency? What on earth could legally justify the seizure of all American gold? The short answer is the Great Depression and looming financial crises in 1933, but in order to really understand the twisted history of national emergencies, we have to go back another 120 years first. In 1812, the United States was at war with Great Britain. Prior to the war, an American citizen, Jabez Harrison, purchased some goods in England and stashed them on an island off the coast of the United States near Nova Scotia. About a month after the war broke out, Harrison chartered a boat, the Rapid, to retrieve the cargo and bring it to the mainland. While en route, it was captured by an American privateer called the Jefferson, who claimed the ship's goods as a prize. Harrison felt, as you might expect, pretty aggrieved by this and sued the owner of the Jefferson. Unhappily for Harrison, he did not win back his cargo. The law was clear and unambiguous, according to Supreme Court Justice William Johnson. Under the well-established rules of war, Harrison was trading with the enemy, and therefore everything he had acquired from said enemy was essentially up for grabs for the government. Thus, the seed was planted in American law. If you trade with an enemy during wartime, expect a visit from Uncle Sam with his hand out. This, believe it or not, is the legal foundation for Executive Order 6102. But I hear you interject, by what definition could an American with gold be reasonably classed as an enemy of the state? And besides, there wasn't even a war in 1933. Fantastic points. You're right. You're right to make them. To preface the answer, let's first take a detour to some high-level American jurisprudence. In the murky but politically charged arena of constitutional interpretation, there are several major philosophies that you might subscribe to. Because the Constitution was written a long time ago, we need to find a way to apply it to the present day, where, for example, we might have new technologies or social problems today that didn't exist when the Constitution was written, like social media or automatic rifles or abortion pills. In such cases, these philosophies help judges decide the right way of interpreting the Constitution, which also usually aligns with their personal political views, but that's another story. If you woke up tomorrow as a Supreme Court justice and needed a cheat sheet to help you crack a tough constitutional nut, here are the main schools of interpretation you might rely on. Textualism, where you focus on the meaning of the law at the time. Originalism, where you focus on what the framers actually intended, or a living constitution approach, where you basically say, to hell with that old rag, we should just update it according to the demands of today. The third approach is more or less how the law around national emergencies has evolved, and not like a slow and deliberate natural selection evolution either, more like a Frankensteinian chimera lab rat fed plutonium for breakfast. So what began as a recognition of the simple idea that doing business with enemies during a war is bad and the government can stop it, eventually mutated in FDR seizing the gold. Now let's fill in the gaps and show how that happened. There are some great contenders for worst year ever in the history of abuses of individual rights in America. 1917 might be the top 5. One piece of legislation passed in 1917, the Espionage Act, was of such fine vintage that it's able to justify obscene government overreach, is still being put to good use today. This package of laws was passed to more or less enable the government to do whatever it wanted to anyone who got in the way of its efforts to prosecute World War I. More than a century later, this would be the law which both Julian Assange and Edward Snowden were criminally charged under. 1917 was also the first time the phrase national emergency passed into the formal language of the presidency, invoked by Woodrow Wilson, first at his proclamation in 1354. The emergency at hand was that there was apparently not enough boats to ship out all of America's exports to customers around the world. As a result, Wilson gave the shipping board the power to control the sale and use of freight ships in America. Leasing your cargo ship to foreign interests? You just did a heckin' violation. This would not be the last national emergency of 1917, however. After America declared war on Germany on April 6th, the administration now had a number of new problems to deal with. Aside from fighting the war itself, there was the issue of what to do with all the German business interests in America and vice versa. In the years since the rapid global trade and commerce had advanced substantially, now there was a vast web of commercial relationships between America and its new enemy, which would take quite a bit of effort to disentangle. The solution was the Trading with the Enemy Act, which brought the principle of the rapid into legislation and vastly expanded it. The official purpose of the TWEA was to define, regulate, and punish trading with the enemy. In practice, the goal was twofold: to confiscate German resources for the benefit of the U.S. war effort and to prevent Germany from doing the converse. Democratic Congressman Andrew Montague argued in favor of the bill by saying, "Perhaps in no former war was trade ever so potential a weapon in the hands of a belligerent as in the present conflict. This is not a war of soldiers so much as a war of economic forces. This, 3 years into a war that had already cost many millions of lives." For obvious reasons, history has largely forgotten what German businesses and civilians endured in America for the rest of the war. Estimates are that 6,000 men were sent to internment camps and around $500 million in assets permanently confiscated. This was all authorized by the Trading with the Enemy Act. One section of it in particular, however, would go on to be the linchpin in the Executive Order 6102 history. That was Section 5B, which gave the president complete power to investigate, regulate, or prohibit any transactions dealing with foreign exchange or by any foreign country. You might sense now that we're getting warmer. The TWA power is evolving, and EO 6102 beginning to take shape, gradually getting clearer like a shadowy apparition emerging from the darkness. But we're not there yet. There's one more hurdle to get over for the president's power in 1917 that was still limited to during the time of war. It would take another catastrophe more urgent than World War I to get over it. That catastrophe would come in 1933, following 4 years of unimaginable suffering during the Great Depression and a quickly spiraling financial crisis. 3 days before FDR was inaugurated on the 1st of March 1933, the head of the New York Federal Reserve Branch, George Harrison, was in panic mode. The bank's gold reserve had fallen below the legal limit. Harrison sent a memo to Washington saying that he would no longer take responsibility for the bank's deficient reserves. What was going on? Well, in 1913, when the Federal Reserve was created, a gold standard was built into its framework. The Fed was required to hold gold equal to 40% of the value of the dollars it issued and to convert those dollars into gold at a fixed price. The problem was the U.S. was in the middle of a deflationary crisis. The economy had been going backward for years. Gradually, then suddenly, people began to seek the safety of gold and withdraw it from banks all over the country. However, there was one big problem. There was simply not enough gold. As FDR would admit publicly a couple of months later, the government's debts amounted to $30 billion in gold, and the private gold-denominated debt totaled another $60 to $70 billion. Meanwhile, all of the gold in the United States amounted to only between 3 and 4 billions, and that all of the gold in all the world amounted to only about 11 billions. FDR's interpretation of the moment is recorded in his inaugural address. He used the speech to wage a broad attack against the excesses of capitalism, which he in history would scapegoat for causing the 1929 Great Depression. He called out the unscrupulous money changers and the falsity of material wealth and demanded that there must be a strict supervision of all banking and credits and investments, and there must be an end to speculation with other people's money, and there must be provision for an adequate but sound currency. Now, if you've been paying attention, you shouldn't be surprised by what he said next. Yes, it was indeed a national emergency, one so severe that it acquired a broad executive power to wage a war against the emergency as great as the power that would be given to me if we were in fact invaded by a foreign foe. It was all downhill from there. 2 days after FDR's term began, He took action to stop the gold run by simply closing the banks. The March 6 Proclamation 2039 instituted a bank holiday from 6 to 9 March, outlawing any withdrawal of gold to stop the, quote, hoarding. Stopping the run wasn't enough, though. Hoarders were now enemies of the state, and the Fed wanted names. On March 8th, the St. Louis Fed sent a memo to member banks requesting the names and addresses of all persons who have withdrawn gold from your bank since February 1st, 1933. On March 9, 1933, Congress passed the Emergency Banking Relief Act, granting FDR almost full personal control over the entire banking system. It gave him authority to regulate any transactions in foreign exchange, transfers of credit between or payments by banking institutions as defined by the president, and export, hoarding, melting, or earmarking of gold or silver coin. Now, here is our link back to 1917. As we mentioned earlier, the Trading with the Enemy Act restricted this power to wartime operations. But as was foreshadowed in FDR's inaugural address, the Emergency Banking Act would help FDR get past this technicality. Specifically, it amended the TWA to ensure that FDR had the power to regulate commerce during time of war, or crucially, during any other period of national emergency declared by the president. FDR had his crisis, and now he had his emergency powers. A couple of weeks after the passage of the EBA, he would issue Executive Order 6102, and then the job was mostly done. By and large, everyone complied. The day after the order, the New York Times ran an article on the front page with the headline, "Hoarders in Fright Turn in $30 million. Gold pours into banks and the Federal Reserve as owners act to avoid penalty." This brings us to the end of the story, from the rapid to the Trading with the Enemy Act to the Emergency Banking Act to Executive Order 6102. The evolution was complete and enshrined the national emergency exception into presidential powers from then on. Natural disasters, foreign wars, domestic wars, public health emergencies. This is the story of 200 years of presidential power. The law is the law until it isn't. Ultimately, this is really what everyone should ask about EO 6102. Could it happen again? Could some unholy triumvirate of the Fed, Treasury Department, and Elizabeth Warren channel the spirit of FDR and attempt a mass seizure of Bitcoin? Nobody can really know, but the best way I can answer the question is with the help of the trusty Midwit meme, which gives us 3 ways of predicting the likely outcomes. And so the guy on the left end of the curve says Fed's going to steal. The guy in the middle of the curve, the midwit, says gold in 1933 can't be compared to Bitcoin today. And then the smart guy on the right side says Fed's going to steal. The left curve answer is to do a basic pattern match between 1933 and today. People had money the government couldn't control. Government wasn't happy. Government stole the money. No more analysis required. The Feds will steal your stuff. The midwit answer is to carefully compare and contrast the nature of gold with respect to the American economy of April 1933 versus Bitcoin and today, and distinguish between the ruthlessly efficient dictatorial powers of FDR and the bungling and incompetent bureaucratic oligarchy of 2024. This isn't exactly wrong, as the midwit never quite is. The particular problem for the government in 1933 was that almost every commercial contract in the country was backed by gold, as was the dollar, and the breakneck run on gold was threatening to implode the economy. None of these things is true about Bitcoin, but the midwit is never quite right either. The right curve answer, if I may humbly submit, is presented in this essay. The meaning of the Executive Order 6102 story is not in the exactness of the analogy from gold in 1933 to Bitcoin in 2024. Rather, it is the nature of the legal power wielded by FDR to expropriate the property of American citizens, the ubiquity and breadth of its use by every president since, and the likelihood of it being used again in the future. History has shown that the invocation of national emergencies has, time and time again, given the United States government almost unlimited capacity to encroach on civil liberties. What does the next national emergency look like? A mass flight to safety from the US dollar to the hardest asset ever known? Could 175 trillion of unfunded liabilities trigger a catastrophic restructuring of American debt, or perhaps another hot war or 3? We don't know what the crisis will be, only that there will be one. As the state debases the currency at an accelerating rate and its liabilities balloon out of control, it will get desperate. In late-stage fiat, just as in the kingdom of Alice in Wonderland's Red Queen, the state must run faster and faster just to stay in the same place. And when the moment of crisis comes, the right curve prediction is simple. The Feds will steal your stuff. Only this time it might be different. For the first time, uh, sovereign custody. Uh, sorry, sovereign custody of Bitcoin has a chance at keeping private wealth safe from public expropriation. So to conclude, the lesson, as always, is not your keys, not your coins, and see you in hell, FDR. So gotta love this piece. It's right on point, and it's exactly why we buy Bitcoin and hold it in self-custody. And last article is also from Bitcoin Magazine. This was posted on April 2nd, and it's an update on BitVM, which I wrote a little bit about in my blog a while back. It's called BitVM 2, Opening Up the Playing Field. Last October, Robin Linus from ZeroSync dropped a bit of a bomb in the form of BitVM. One of the longest running criticisms of Bitcoin is that it's not possible to make arbitrary programs to control how money is spent or locked. Bitcoin only has very limited amount of programmability in its scripting language, and the primitives available are extremely constrained. You can check a signature, you can add a time lock to something, you can manipulate data in a few simple ways, but that's it. You can program a Bitcoin UTXO to require a signature check, a time lock verification, etc., but you cannot program it to unlock based on any arbitrary conditions. Robin's insight with BitVM was that one single primitive in the field of computing could be enforced in Bitcoin script, a NAND gate, one of the basic primitives of computing at the physical electrical level. Every computation that is possible can be constructed out of NAND gates. Script can actually verify a NAND gate due to a neat trick using op booleand and op not. Op booleand is an AND operation. The opposite of NAND, op not, takes a binary 1 or 0 values and inverts it. This together allows you to actually enforce a signal NAND operation in a script directly. In combination with hash locks, a NAND gate script can be made where each input and output field has two possible hash locks to unlock that spending path, each one pushing a 1 or 0 to the stack to perform the NAND operation. Each script also has a path where if you can reveal both pre-images to a single bit value, you can immediately claim the funds. This is so that once someone decides what to input to the NAND gate, they cannot change their mind without losing money. A massive amount of NAND gate scripts can all be compacted into a taproot tree, and once someone commits to the bit values off-chain to input into that computation, the other party can challenge them on any individual step in the computation to prove it is being executed correctly on-chain. Each challenge allows the challenge party to prove that the individual gate was computed correctly, otherwise the other party can claim the funds after a time lock. Going back and forth like this, if a computation is contested, it is guaranteed that the cheating party will eventually be caught and lose funds. The main limitation of BitVM is that only the people involved in creating a BitVM contract can participate, and the roles are very limited. There's the prover, the person asserting how much the computation happened off-chain, and the verifier, the person who can challenge the computation and force it to be proven on-chain if the prover does not complete the computation off-chain or tries to lie about the results. One of the reasons for designing BitVM was to establish two-way pegs to side chains or other systems. The scheme offers a very powerful primitive in that use case, the ability to actually enforce funds be given to one party or the other based on the correctness of an arbitrary computation, i.e. a validity check on whether a peg out is valid according to the side chain's rules. The problem is, only the people who hold keys to that BitVM UTXO can actually go, hey, you're cheating, when someone is, and engage in the challenge protocol. This ultimately makes the system still trusted. Another limitation is that the challenge response protocol can be very long. If someone realizes the outcome of the computation is going to result in them losing money and they stop responding, the verifier has to essentially guess where the individual NAND gate is in the computation, that the prover would have to lie and reveal both pre-images to a bit that would give the verifier the funds. Until that specific gate is challenged on-chain, the prover can still respond correctly to a challenge and drag it out. This can be very time-consuming and inefficient. Some improvements to this design have been made since the original proposal to allow for multiple verifiers to exist in the system with the prover to create a one-of-n trust model where only a single verifier is required to challenge a dishonest prover. However, this requires an instantiation of multiple BitVM instances in parallel to accomplish and therefore increases the inefficiencies with the original two-party design. Robin recently proposed a design scheme for BitVM2. This scheme seeks to make a few trade-offs in comparison to the original design for the benefit of mitigating its two major shortcomings. BitVM2 shortens the challenge response protocol length from an indeterminate series of transactions that could be upwards of dozens in the worst-case scenario to 2 rounds in the challenge response. In addition to this, with the use of connector outputs, it allows anyone to act as a verifier. It does not require someone to be a member involved in establishing the BitVM to challenge a dishonest prover. The fundamental shift here is moving away from directly using script NAND gates to implement the raw computational trace directly and moving to using them to implement a general snark zero-knowledge proof verifier, one of the core primitives Robin intended from the start to implement using BitVM. Instead of putting the raw input into the raw computational trace and running it gate by gate in their own tap-leaf scripts, the input of the BitVM2 instance would simply be a knowledge proof input in combination with an asserted output of the computation. And then I'm not going to read the rest of it because it's super detailed and technical, but if you'd like, please check it out. I'll leave the link in the show notes. And if this is over your head, check out my Bitcoin Fortress blog and search BitVM. I did an article that breaks it down and tries to simplify it to a non-technician to understand what exactly BitVM does. But essentially, it's like using the Bitcoin network as a computer to run smart contracts, but it's all done off chain, so it doesn't require changing the code. And or messing with the foundational security of Bitcoin. But it is very intriguing. And then apparently BitVM2 is an enhancement of the original proposal to overcome some of its limitations. So deep technical stuff, but interesting nonetheless. And finally, just wanted to highlight this week's blog post on the Bitcoin Fortress newsletter, Rethinking Traditional Financial Wisdom, Embracing Bitcoin for Financial Freedom. And as always, I'll include a link to that in the show notes. Okay, thanks for listening to the podcast. If you enjoyed the show, please like and leave a comment. Don't forget to subscribe on your favorite podcast app if you don't miss, so you don't miss an episode. If you're listening on Fountain, you can earn sats for listening, which is great. I'm also running a promotion right now on Fountain. So if you're new to the podcast, welcome. And I hope you'll continue to listen going forward. You can follow my Substack at bitcoinfortress.substack.com. And I am only on Nostr. My NPub is in the show notes. And with that, I will talk to you all next week. Bye-bye.